Guys, so today point, what are government bonds? Government bonds are the debt instrument the government issue to the pay for government expenditure within the United States of the federal governments. The issue including the saving bonds, treasury, the notes, the treasure, the bonds are the tips or the treasure, the inflation of the protect the securities investor and should carefully consider the risk that the different countries governments possess the before they invest in the bonds. Among these are the international governments. The risk are the particles risk or country risk, interest risk, and the inflation risk. The government generally have or less credit risk thought not always. Saving bonds are either type of the United States the government's bonds, that is the treasury the department the sale that is the available in and the electronic form. The treasury the offer them is the directly from their website, and the individual can buy them from the majority of the financial instrument institution and the banks. When the saving bonds are the maturity, then Mr. get the back the bonds the face value along with interest, which is the assured. These saving bonds many the note be the redeemed the first year of issue, and the investor who the redeem them in the first 5 year of the issue lost 3 months interest for cashing out too early. The treasurer of the United States also the issue intermediates time frame bonds, the known as treasury notes, or the notes are the this is the notes that provide the interest payment the semi-annually at the coupon rate, which is the fixed. These the notes that typically are the denominated in $1,000 face value. Those with 3 or 2 year the maturity dates the come in the five five thousand 5,000 $5,000 domination the before the 1984 T notes, where the labels and give the treasury the right to the buy them back given a specific the condition. The US the government the longest the term bonds are the treasury bonds of the T bonds. The this is the have the maturity other it is the running of the from the 10 to the 30 years of the time. They also the provides the interest the payment on a semi-annually the basic of the come in the $1,000 the dominated values. This is the T bonds. R is the important. B cost, this is the pay of the federal the budget that the shortfalls are a form of the monetary the policy, and the the ensure the country of the able to the regulated. It is the money the supply is the, all the bonds are the issuer, that is the treasury the department looks at is the return and the risk the requirements on the markets when in the goes to the raise the capital to so that it the can be as the efficient as possible. This help of the explain the different kind of the tertiary security of this is the government bonds of the offer. US governments bonds have the generally been in the considered to be the without risk, which is why they trade so easily in the extremely large and the liquids the markets. The downsides to this is that they offer considerable lower return than to other bonds. Tips to not provide the protection and against the inflation, so that is the inflation the increasing will not the exceeds that is the interest rate of the bond. The price of the governments the bonds are the based on the current interest rates. This means that is the fixed rates the bonds will decline in the value of the interest rates rise since there is the lost opportunity to the obtain the newer bonds that is the higher interest rates. The similarly, if interest rates fall, the bonds value will rise. The federal government it is the able to the control the money the supply in the part by the issue of the government bonds. If this is the ways of the increasing the money supply, they have the simply the buy the back there on the bonds. These funds they find their way to the bank and they expand the money supply is the banks keep the small reserve and the loan the rest out in the money multiplier effect. The government is also able to the lower the money lower the money supply by the selling additional bonds which tax the money out of the circulation. If the government the where is the retire the funds of the receipt from the sale of these bonds, it would the reduce the available money supply more often that not the US government spend the money. Thank you for watching my video.